Today, I would like to discuss a simple idea, one that has guided intelligent investors through countless market cycles. The idea is this: be greedy when others are fearful, and be fearful when others are greedy. Now, on the surface, this statement has a clever, paradoxical ring to it. But to dismiss it as just a witty slogan would be to miss its profound depth. This simple sentence contains a complete worldview for the investor. It is a guiding star for navigating the turbulent and often irrational seas of the market. It tells you not only what to do, but, just as importantly, when to do it. It is a recipe for exploiting the market's recurring emotional extremes, not through cunning, but through discipline and a steadfast focus on long-term value. The statement is a whole, a complete philosophy in two halves. But to truly understand it, we must break it down. We cannot swallow it whole. Trying to apply both halves simultaneously can be confusing. It is like a carpenter trying to learn to use a saw and a hammer at the exact same moment. Mastery comes from focusing on one tool, understanding its weight, its balance, and its specific purpose. Therefore, today, we will focus our entire discussion on the second, and in many ways more psychologically difficult, half of this maxim: be fearful when others are greedy. This is the art of knowing when to exercise caution, when to hold back, and when to be content to sit on the sidelines while a euphoric crowd believes the party will never end. It is a lesson in discipline that is every bit as critical as the courage to buy during a panic. But a compass, by its nature, has 2 points. It tells you not only which direction is north, but by implication which direction is south. To follow only one point is to travel in a circle, not a straight line. The same is true of our maxim. To practice only the first half, to only be greedy when others are fearful, while ignoring the second, is an incomplete and potentially dangerous strategy. It is like knowing how to accelerate a car, but not knowing where the brakes are. Today, we complete the picture. Today, we turn our full attention to the second, and in many ways more psychologically difficult, half of the principle: be fearful when others are greedy. Let us again anchor our discussion in the perspective of a sensible long-term investor who has chosen the prudent path of investing in a broad global index fund. This investor owns a piece of thousands of businesses around the world. They have diversified away the risks of individual companies and specific industries. Their fortune is tied to the long-term progress of global commerce. Our question today is, what does this investor have to fear, and when should that fear manifest? To understand this, we must first redefine this particular kind of fear. In the context of a market panic, fear is a visceral emotional reaction, a desire to flee. But in the context of this principle, fear is something else entirely. It is not a panic. It is not a sleepless anxiety. It is a conscious, rational, and calculating caution. It is the disciplined wariness of a seasoned traveler who knows that when a path is too smooth and too well trodden, it may lead to a precipice. It is the intellectual recognition that when prices ascend to dizzying heights, detached from the underlying economic reality of the businesses they represent, risk is not diminishing, it is accumulating. This fear is not an emotion to be suffered, it is a tool to be applied. To illustrate this concept, let me offer a new parable. Imagine a vast and fertile valley where the climate is temperate and the soil is rich. This is the valley of rational value. In this valley, a community grows a magnificent collective orchard. The trees are thousands of public companies, and they produce a harvest of earnings each year. The value of the orchard is determined by the size, health, and productivity of these trees, the intrinsic value of the businesses. The price of a share in this orchard, however, is set by an auction held in the town square every day. For long periods, the auction is a sober, sensible affair. The townspeople, the investors, examine the orchard, estimate the coming harvest, and bid prices that reflect a reasonable return on their investment. A share might sell for 15 or 20 times the annual harvest it represents. This is a fair price. But then a season of euphoria begins. Perhaps a new, exciting type of tree is discovered, promising unheard-of yields. Perhaps a series of perfect weather reports suggests the harvest will be boundless. A wave of infectious optimism, a collective greed sweeps through the town. The people in the square are no longer just the prudent farmers. They are joined by speculators, by dreamers, by people who have never grown a tree in their lives but are captivated by the stories of instant wealth. The bidding in the square becomes frantic. People are no longer buying a share of the future harvest. They are buying a ticket to a lottery. They stop looking at the orchard altogether and start only watching the other bidders, convinced that someone else will always be willing to pay more tomorrow. The price for a share of the orchard, which was once 20 times the harvest, soars to 40 times, then 60 times, then 100 times. The value of the entire orchard on paper far exceeds the value of every single tree and every piece of fruit they could possibly produce for a decade. This is the moment of greed. This is the environment where our second principle must be applied. For you, the disciplined index fund investor, the fundamental question in this moment is not, how much higher can it go? But rather, what am I actually getting for my money? When you invest new capital at these inflated prices, you are paying a tremendous premium for a future stream of earnings that is almost certain to disappoint such lofty expectations. The math itself turns against you. Buying $1's worth of future earnings for $2 or $3 is not a recipe for long-term wealth. It is a recipe for long-term disappointment. The risk is not that the orchard will fail. The risk is that you have paid a foolish price for your share of it. Being fearful in this moment does not mean selling all your possessions and hiding in a cellar. It means adopting a posture of extreme caution and discipline. It means recognizing that the margin of safety, the gap between the price you pay and the underlying value you receive, has evaporated, and in its place is a margin of danger. It means that when everyone is rushing to buy shares at any price, you are the one who is content to stand aside. You are fearful of the poor long-term returns that such exalted prices almost guarantee. Your fear is not of a crash, but of a long, slow grinding period of low returns, or worse, permanent capital impairment for those who bought at the peak. So, how does one identify this moment of widespread greed? The signs are, in many ways, the mirror image of the signs of fear, but they are often more seductive and more difficult to resist because they feel so good. You will see it in the headlines, but they will not be filled with doom. Instead, they will be saturated with euphoria and a sense of invincibility. The financial news will feature stories about a new era where old rules of valuation no longer apply. You will hear phrases like paradigm shift, and this time is different. Pundits will appear on television not with grim faces, but with the fervent glow of evangelists explaining why a certain sector or the entire market can only go higher. The narrative is one of inevitable and perpetual growth, untethered from economic cycles. You will feel it in the conversations around you. The same friends and colleagues who were once silent about their investments will now talk about little else. The dinner party chatter will shift from sports and movies to the can't-miss stock tips everyone seems to have. The cab driver, the barber, the dentist. They will all have a story about the fortune they are making in the market. The prevailing wisdom, the consensus view, will be that it is foolish not to be fully invested and even leveraged. You can't afford to miss out, will be the mantra. This pervasive consensus of greed becomes so thick that to express caution is to be labeled a dinosaur, a pessimist, someone who just doesn't get it. You will see it in the behavior of companies and investors. This is when you see a flood of initial public offerings for companies with no earnings, no proven business models, but a fantastic story. This is when you see massive amounts of speculation in obscure assets, driven by the belief that they too will only go up. It is a period of financial engineering where debt is taken on cheaply to fuel further speculation. And, of course, you will see it in the numbers. The market, as measured by a broad global index, will be at or near all-time highs. More importantly, valuation metrics, such as the aggregate price-to-earnings ratio of the market or the ratio of total market capitalization to the size of the economy, will be flashing red, reaching levels that have historically been associated with very poor subsequent returns over the following decade. The price of a share in that fertile valley has become unmoored from the reality of the harvest it can produce. Identifying the moment is one thing. Mentally preparing for it and then acting correctly is the true test of an investor's mettle. The siren song of easy money is a powerful force, and resisting it requires a fortitude that is even rarer than the courage to buy in a panic. How does one prepare? First, you must have an unwavering belief in the laws of financial gravity. What goes up must come down is not quite right in the market. A better formulation is, what goes up too far, too fast, relative to its underlying value, will inevitably revert to the mean. There are no perpetual motion machines in finance. Periods at exceptionally high returns are almost always followed by periods at exceptionally low or negative returns. Internalizing this iron law of reversion to the mean is your intellectual anchor. It allows you to watch the euphoria with a detached skepticism, knowing that the party will end and that the hangover is proportional to the excess. Second, you must, as with the first principle, have a pre-written plan. Your investment policy, crafted in a time of calm, must have explicit instructions for a time of euphoria. What will you do when valuations reach extreme levels? Your plan might state, I will never, ever cease my regular monthly investments, as this is the foundation of my long-term strategy. However, if the market's cyclically adjusted price-to-earnings ratio rises above the 90th percentile of its historical range, I will redirect any excess cash I was planning to invest into a safer, short-term vehicle and simply wait. I will not attempt to time a top, but I will refuse to overpay. This plan disarms the greed in your own heart. It gives you a script to follow when your emotions are telling you to throw caution to the wind and join the crowd. Third, you must cultivate a mindset of absolute patience and contentment. The hardest part of being fearful when others are greedy is not the selling. For the long-term index investor, it is mostly about not buying. It is about watching others seemingly get rich while you are sitting on the sidelines with your capital, waiting. This can feel like a form of failure. It requires the patience of a hunter who is willing to let the herd pass by because he knows the animals are too lean and that a better hunting season will come. You must be content with the returns you have already made and not feel compelled to chase the last dollar of a bull market. The greatest investors are defined not just by the great deals they make, but by the terrible deals they have the wisdom to avoid. Finally, what does being fearful actually mean for the index fund investor in the moment of greed? It is critical to be precise, as drastic action is rarely the right course for a long-term holder. It does not mean selling all of your index fund holdings and going to cash. For the vast majority of investors, this is a catastrophic error. Trying to time the exact top of the market is just as foolish as trying to time the exact bottom. You will likely sell too early, watch the market continue to rise, and then be faced with the agonizing decision of when or if to get back in. This is the path to whipsawing your own portfolio and missing the handful of best days in the market that account for a disproportionate share of long-term returns. For the core of your long-term buy and hold index fund investment, the default action is to hold. So, what is the actionable fear? It means, first and foremost, having the discipline to stop adding new money at dangerously high valuations. If you have a lump sum of cash to invest, this is the time to be fearful of deploying it all at once. It may be wiser to dollar cost average it and slowly over time, or to simply hold it in reserve for the inevitable storm that follows the sunshine. You are fearing the poor return on that new capital. It means scrutinizing your own financial behavior. Are you being tempted to take on debt to invest more? Are you considering dipping into your emergency fund because the market seems like a sure thing? This is the time for fear to stop you. This is when your rational caution must override the greed of the crowd. It means conducting a sober audit of your own risk tolerance. When the market is soaring, everyone feels like a risk taker. But this is an illusion. This is the time to ask yourself, if the value of my portfolio fell by 40%, would I be able to stay the course, or would I panic and sell? If the answer is, you might panic, then being fearful might mean gently rebalancing your portfolio back to its target allocation, perhaps taking a little profit from equities and moving it into bonds. This isn't market timing, it is risk management. You are selling a small amount of what has become overpriced to buy what has become relatively cheaper, and in the process, you are locking in a comfortable risk level for yourself. The beauty of this approach for the index fund investor, once again, is its simplicity. You are not trying to pick which individual stock is a bubble. You are looking at the entire forest and concluding that the trees are overpriced. You are making a broad, disciplined judgment that the expected return from the entire market from this starting point is low. Your fear is a rational response to poor future odds. In the end, being fearful when others are greedy is the ultimate test of emotional independence. It is the ability to remain sane when everyone around you is losing their heads to euphoria. It requires the wisdom to know that the most dangerous words in investing are, "This time it's different." It requires the strength to be unpopular, to be called a pessimist, and to forgo immediate gains for the sake of long-term safety and sensible returns. When we combine this with our understanding of the phrase, "Be greedy when others are fearful," we see the complete picture. The intelligent investor is not permanently greedy nor permanently fearful. They are a thermostat, not a thermometer. A thermometer simply reflects the temperature of the room. It goes up when others are greedy and down when others are fearful. A thermostat, however, acts to regulate the temperature. It switches on the cooling of caution when the room becomes too hot with greed, and it switches on the heating of greedy accumulation when the room becomes too cold with fear. This balanced discipline, to be greedy when fear is high and fearful when greed is rampant, is the heart of a contrarian strategy. It is a strategy that acknowledges that the market is a pendulum that forever swings between unsustainable optimism and unjustified pessimism. The intelligent investor's goal is to be on the right side of that swing, not to predict its arc, but to react to its extremes with a predetermined and disciplined plan. By understanding and applying both halves of this simple saying, you arm yourself with a timeless philosophy. You learn to respect the markets without being intimidated by them. You learn to harness the emotions of others without being enslaved by your own. It is a path that leads not to speculative riches, but to the steady, dependable accumulation of wealth over a lifetime.